William, thanks for joining us today.
Yeah, happy to be here.
Man, this is exciting. We've William and I have worked together for coming up on 5 years. We just made partner together at Excelsior Capital, and it's a special time to have him on as a guest, and to we're still early enough to consider this kicking off the podcast in general. So what exciting times at Excelsior.
I know I just hit my 6 year mark, which is also means I've been in Nashville for 6 years now.
6 years and 30th birthday all in the same month. It's a big month for you.
It has been a big month.
Let's kind of dive into your background a little bit,
Okay.
where you came from, what you went to school for, kind of your early on career process, and how you ended up at Excelsior Capital.
Yeah, I'm actually from Memphis, so just a couple hours down the road. Born and raised there. I went to Auburn University for college. I majored in finance there, and actually pursued the CFA charter shortly after graduating. Was successful in that. I started out, I did take a real estate class in college, but really never thought it would be the world that did live in. Started out in a more traditional role at a big bank, actually two different big banks. Started out in Jacksonville and moved to Atlanta. I was most recently with SunTrust, Robinson Humphrey at the time, now Truist, and just realized I wasn't totally happy or didn't see myself in the role that I was doing long term. Um, so I started doing the whole networking thing, um, and really 6 months before I got the job here, I was introduced to uh, Brian through a guy named Jimmy Beard. That's no longer with the firm, but back in Memphis, and so introduced myself, got to know them a little bit. And then, fortunately, 6 months later, an opening came available for an asset management position. So, a little over 6 years ago, I started here on the asset management side. I shouldn't say here, at a predecessor entity, Priam Capital. Started out on the asset management side, which is for those of you that don't know, in commercial real estate, is managing a property on a high level on a day to day basis. So, working with leasing brokers and leasing teams, as well as your local property manager, to ensure that the building is performing as underwritten or as close to it as possible. So I was doing that for about a little over 1 million square feet in 5 different markets here, and then um, that portfolio was recapitalized with a private investor. And when that transaction was completed, um, we not we but Brian and Abhishek started Excelsior Capital and brought me over, and at that point I shifted more into a acquisitions focused role. And I guess that was mid 2019 when that happened. So I've been doing what I'm doing now for 4 to 5 years.
Yeah, William actually technically hired me in mid 2019. So him and one of our former colleagues, Sam Peacock, were kind of the first two to be brought over to Excelsior, with Brian Adams, who was our founder, and I was their first hire. Brian jokes sometimes that I was the only one that they could get to take the job. We don't have to dive into that, but they were looking for a CPA that could talk, and somehow they found me. So I'm incredibly grateful that they took the leap there. Why the CFA designation?
Well, I knew I liked the investment space, and um, I just felt like it's always something that interested me. I'd met several different professionals through internships and then at SunTrust that had it. And so I was just, the academic subjects behind it interested me. So all aspects of investing, corporate finance, and you name it is covered. And, I was a finance major, so I already had a level of knowledge, certainly not, you know, probably 5% of the CFA curriculum, but it's what interested me, and I knew it was a qualification that came highly regarded for those that had it, and it maybe opened up doors that I wouldn't necessarily have if I hadn't done it. So And typically it's kind of regarded as the highest certification in the finance world, and that's the world that I was in. So I wanted to have that designation. And at the time, I didn't know exactly what I wanted to do, and so uh, I knew I wanted to be in the investment space. And so, given that, I figured it would be a great time. I was single, young, had time on my hands outside of work, just focused on studying for it, and just decided to jump in.
Has it been helpful on the real estate side?
For sure. I mean, it really, more than anything, it teaches you how to think about investments in finance. It teaches you how to understand them and, suitability and practicality, I should say. Um, Coming in, not being in real estate, but having that background, I think it gave me a leg up in picking things up. Obviously, real estate's a 5 to 10% component of it. A lot of that is geared towards REITs, but nonetheless, just being able to have a strong understanding of income statements, balance sheets, cash flow statements, and the importance of each of those things, I think made the transition very easy for me.
Yeah, so let's maybe dive in to that transition a little bit. So you started with an asset manager. For those that aren't familiar, how is a asset manager different from a day-to-day property manager at the property?
Yeah, that's a good question. Day-to-day property manager is the person that's talking to the tenants if there's issues or projects that need to be done at the property. They will manage that process. They will collect rent. If a tenant's not paying, they'll handle that situation. If we want to, uh, you know, clean all the exterior glass at the property, they'll reach out to vendors, get quotes, run that process. So they're really managing the building itself um, on a day to day basis. And
Okay.
then, sorry, an asset manager is really the best way to look at it is the owner's representative for the property on a daily, weekly basis. So if something comes up uh, that's not routine operation at the building, say there's a plumbing issue or a tenant isn't paying rent, obviously the property manager will be the first level of contact for tenants, but that property manager will come to the asset manager, give us his recommendation, and we'll talk through how we want to handle that. They're kind of the high level manager of the property, if that makes sense.
Yeah, no, it makes a ton of sense. And I think it's an important factor for listeners to understand or to kind of think about is that, we have at Excelsior, we have boots on the ground, um, people that are putting out fires or dealing with kind of the mundane day to day type stuff. And then you have someone like an asset manager on our team who is thinking more high level strategy. It's kind of that difference between like tactical and strategic thought
Right.
processes, if you will. I love kind of your progression and that transition that we were talking about, like having that investment background, moving into kind of learning the components of real estate and the asset management world, and then now to the acquisition side. So, one, what does acquisitions mean? What does that look like? And two, how has your time that we just discussed in the investments world come in kind of learning the CFA side of things? And then on the asset management side, how has that set you up for this role as our director of acquisitions?
Yeah, that's a good question. I will say that spending time in a pure asset management role was key for me to be able to underwrite investment opportunities. Now, taking a step back, uh, here the acquisitions role is defined as sourcing opportunities, so going out and finding buildings to buy, and that happens through various avenues. It's not consistent. There are deals that we buy that are sent out kind of on a broad email blast by a brokerage firm that all of us have heard of, like a CBRE or a Cushman and Wakefield, JLL, just to name a few. There are off-market deals that happen for whatever reason. Maybe we're already in a market, so we're in a market like Atlanta. Brokers see that we've acquired multiple buildings there, have a track record and a reputation as a firm that will acquire property and do so in a pretty professional manner, no retrades, things like that. So we'll get off-market looks. as well, and a little more rare for us, but we'll even have owner to owner transactions that have happened in the past without a broker. Those can be a lot of work. I think my preference is buying a deal off market that is brought to us by whether a leasing broker or a sales broker that's kind of more local. Um, those are really the three avenues that we pursue. We haven't bought anything off auction. I don't think that's I don't think that's a strategy that kind of fits what we're trying to do, anyways. But that's
Yeah.
how that's how the role is defined. And at any given week, my time can be spent a lot of different ways. So if we are kind of in the home stretch of an opportunity that we're under contract on and due diligence is mostly complete, at that point I'm doing the little things to make sure we're progressing towards closing, but really focusing on finding new opportunities. So talking to brokers, underwriting deals, spending a lot of time at Argus and Excel. That's where a lot of my time is. That's where we are in the process. But if we're early in the stages negotiating PSA, or maybe pondering submitting an LOI, a lot of my time is spent on that specific property, um, and talking to potential lenders. We work with a mortgage group here in town, and so talk to potential investors, potential lenders. Obviously, I'm talking to the broker who's the seller proxy, and so my time, in weeks like that, just looks a lot different, which is what I really like about the role. It's very dynamic and constantly evolving, as I'm sure you're aware.
Yeah, absolutely. We're similar in that regard. And I want to dive into kind of what that acquisition process looks like. So, more into maybe what your day to day is here in a little bit. But let's first start with kind of state of the real estate market, right? There's a mix of headlines right now. Some of the negative ones are primarily driven by um, maybe the impact of current debt markets or the impact of the pandemic as it relates to major metropolitan office space. What do you see as kind of the main dynamics of the real estate market as we currently see it? And again, for context, this is late February of 2024.
Yeah, for the world that we play in, which is call it $5 to $25 million purchase price buildings. Um, really, I mean, and this applies to all asset classes, but it's been a lot slower over the last 12 to 18 months. Buyers or sellers got accustomed to pretty aggressive pricing, 2 to 3 years ago, and obviously rates shot up as quick as they ever have, which just dried up a ton of liquidity. And so there was a 6 to 12 month period where sellers and buyers were just on a totally different playing field. When you're going out and buying properties and you can lock in a 3 to 3.5% interest rate, you can pay a higher price and still, likely succeed in pretty strong yields and returns. When those interest rates double as high as 7 to 8%, depending on the type of debt you're using, um, you lose a lot of that buying power because a stabilized asset that maybe was trading at a 6.5 cap, that could be light industrial, that could be medical office. When you buy that with a 3.5% interest rate, 60%, 70% LTV with some interest only on it, you're talking about a very compelling, close to double digit cash on cash yield that property is going to kick off. Now, you buy that exact same property price at a 6.5 cap with a 7% interest rate, probably no IO, maybe 1 year. Your leverage is actually going to work against you, and you're not talking about hardly any yield. And so when you're typically, obviously we're not that old, but typically rates don't change that quickly. And because they change so quickly, it was just kind of a shock to the market. So if you were a seller that didn't need to sell, you didn't have an impending debt maturity, it was silly for you to really go out to market and consider a sale because you likely weren't going to get what you wanted. And so things really stalled out. I would say 12 months removed, 18 months removed where we are now, Obviously, there's been buyers that have had to exit, so that's put some supply in the marketplace, and I think there's kind of been a reaching of the middle ground between buyers and sellers. It's somewhat clear to me that we're not just going to have 200 basis points cut of interest rates anytime soon, and so the capital markets have kind of recalibrated, and you're starting to see a little bit of an uptick in activity, especially when we cross that threshold into the new year, when we've got basically a fresh vault of banks and life co debt that needs to be deployed. I feel like we've started to see an uptick in activity.
Yeah, so for those that maybe aren't aware, we kind of saw a pendulum of extremes in that you come out of the pandemic and rates are low, liquidity is high, and so is sentiment. And so there was a lot of competition within the market. And then you have the fastest rate hike in history, I think. Don't quote me on that. And the pendulum swung to the other side, right? So liquidity dried up, rates went up, and sentiment dropped. And so, as William alluded to, we kind of saw a little bit of a stalling out in the amount of supply that was coming on hand from our perspective. William, if you're a seller or a potential seller over the last 12 months, why would you take your property to market versus waiting 24 to 36 months?
That's a really good question. I think if you have an asset that is performing well and you have a pretty strong expectation that it will continue to do that, it probably makes sense to hold at least for another 6 to 12 months till we have a little more clarity on interest rates and if we're actually going to see cuts. Um, the probabilities seem to be changing on that daily, so there's no point in even trying to project that. Uh, but there are external factors out there. There's this may be the last property that you own in a fund that you're winding down. You may have a 5-year mandate on a hold period, and investors are expecting their capital back. Um, Maybe you bought this as a deep value add asset, and it's not the perfect situation to sell. But if you are selling, that owner or that GP is going to hit their promote, and so they're happy to exit anyways. There's a lot of external circumstances that are typically going to drive most sales that you're seeing today. And then the common one is, this owner is getting older, he's local, and he wants to retire. I feel like that's almost a little bit of an overplayed circumstance by brokers because I feel like I hear it every other deal. But at some point, that's true for some sellers. So I probably wouldn't sell most assets right now, but if you've positioned your asset in as strong of a place as you think it can be, then you're going to get a reasonable offer. I would say the market now is probably as rational as it has been in the last 3 to 4 years. People aren't really going crazy and overpaying like we were seeing with some of the 1031 rush a year or two ago. But if it's a quality deal that is in a good location and deserves to have a nice price attached to it, I feel like you're going to achieve that price if that makes sense. You're less likely to get some insane offer that's 125% of your asking price. I feel like markets are just a little more rational right now.
Yeah, I would agree with that, and it's probably something you don't hear, especially if you're just looking at the headlines and that the market is rational. But it really has stabilized, I would say, over the last 6 to 12, maybe more like 6 months. You mentioned that in terms of considering debt, uh, early in the year there being kind of that fresh vault for bank lenders and life cos. What did you mean by that?
Yeah, so any given year, banks kind of have at the end of year, so December, they kind of make their plans for the following year and they set allocations for each asset class or investment type, whether new development, construction, or an existing asset. And so come January 1, their allocations are completely empty. So they can allocate to any asset class. They've got fresh powder to go out and lend. Whereas at the end of last year, call it Q4, banks have really tightened up, and a lot of their multifamily or industrial allocations have been made, and so they may have money to lend, but it only would could fit certain asset classes or certain stages of development. And so at the beginning of the year, that simply refreshes.
Yeah, I think that's probably one of the unseen aspects of our business, right? Is that, you know, the type of quote or interest we could get in a property may be different towards the end of the year than it is the beginning. And it's just one of those unseen aspects of kind of what William and I do on a day in, day out basis. Let's start taking the conversation more back to Excelsior in general. And this is going to kind of allude back to the debt conversation we were having, but how has that Excelsior investment thesis evolved over the last, call it 24 to 36 months?
Yeah, I mean, again, it's not entirely driven by debt, but that is a large driver of the change. Um, 3 years ago, we were really focused on cash flow or yield, or cash on cash return, whatever you want to call it. I like to just use cash yield, and interest, and really using, it's not arbitrage, but the the wide gap between interest rates and cap rates that you can find in certain asset classes. So flex, light industrial, medical office are two of those, or were two of those at that time, where you could buy quality assets, north of a six cap, put on fixed term debt, a lot of it being CMBS, less than 4%, and just capitalize on that positive leverage, the difference between those two rates. And what you see when that happens is that your cash on cash yield is pretty solid, high single digits, maybe low double digits if you average it out over a 10-year hold. And the assets were very vanilla. There might be a little bit of a value add component, but generally they were all 90% plus occupied, a popular term known as WALT in our world. And you would buy those and really not do anything fancy once you purchase it. Making sure we're bringing in our institutional, quality asset management, but from a day-to-day basis, we were trying to retain tenants, gradually increase interest rates, and just maintain a high-quality property. Fast forward to today, for groups like us that have a higher cost of capital and a taxable investor base, and that's comparing to institutional groups that maybe have a much lower cost of capital, those deals aren't as attractive anymore. They don't offer compelling returns for a group like us. And so what we've really started to hang our hat on is buying properties at a good basis. So really in any cycle on a per square foot basis, you feel good about your going in cost. You want to be below replacement cost, which honestly, for the types of assets that we're buying, replacement cost just due to construction increases has gotten extremely high. So that's not a difficult ask in a lot of these markets. And that's part of the reason the light industrial, the flex industrial asset class is so compelling. But focusing on basis and also focusing on opportunities where we can grow NOI organically by about at least 25 to 30% over a 3 to 5 year hold period. And that's typically accomplished in two different ways. One is vacancy. So maybe it's an asset 75% occupied, and we have a compelling story as to why we feel like we can lease that up. And this is especially common in the light industrial space, rents are 30 to 40% under market. And we have comps, and there are comps to prove that, and other buildings in the market that are leasing at rates that justify, those rate increases, excuse me. And so those are really the two types of value add stories that we're looking at. Because the thesis that there is if you're buying something and you can increase net operating income by 30%, regardless of the capital markets, let's say cap rates expand 50 basis points, you're still going to sell that at a premium to what you bought it for because that NOI, I'm sure most of y'all listening know what a cap rate is, but it's simply net operating income over the purchase price. And so if you can really drive that numerator, the denominator is going to take care of itself, kind of regardless of the economic cycle. And that's why we've really shifted our focus more so on finding good basis opportunities that have upside. We want some level of stability typically, especially if we're going to use debt on the transaction. We have bought deeper value add opportunities all cash, but typically we want some stability, but with a lot of room for upside potential.
Yeah, I'm glad you went there on the definition of cap rate. You beat me to it because that was my next question. Um, so at Excelsior, we focus on medical office and what William calls industrial flex. Why are those two the main asset classes that are asset types that we focus on? What are those? Why are those attractive to you?
Yeah, there's on the medical office side, they both have different stories. The medical office side is a little more of a demographic play. Typically, these investments are a little slower and a little steadier, so maybe a little less upside, but they're longer term holds. And this has to do with the fact that the reality of the aging baby boomer population, and also the fact that hospital campuses are increasingly pushing non essential services off campus, so into medical office buildings. Those are the trends that we really like. And then from a real estate perspective, we love the dynamic of a medical user. So they have highly extensive build outs that require a lot of plumbing typically. And it's just extremely expensive for them to move. And it's extremely expensive for a new landlord to bring them into their building. And given that, they're extremely sticky tenants. And a lot of them are very location driven. So say you're a dentist and you've been operating out of a location for 10 years. It's not going to make sense for you to move to a different part of town and kind of have to reestablish a new customer base. Um, it's easy for your customers to kind of just to get acquainted to where you are and keep going there. So we like the demographic story of medical office and the trends that kind of support it or the tailwinds. And then we also like the nature of the tenancy and how sticky they are long term. On the industrial side, it's a little different story. It's really a supply and demand equation that we like. All new industrial, not all, but the vast majority of new industrial buildings that are built in secondary and primary markets. We were just in Austin last week. It's a perfect example. Due to the cost of construction, it really only makes sense for developers to develop this large what we call bulk industrial warehouses, where the level of finish, which for a non-real estate person is just the amount of office or maybe retail or showroom, whatever, for depending on the user, um, built out that they have. And typically for this bulk stuff, it's less than 10%. And they also want tenants that are huge. So call them what huge in our world. So 25,000 square feet and larger. Um, by building a building that's 100,000 square feet and having 2 to 3 tenants in it, your build out cost on the inside the shell are drastically reduced as opposed to building that exact same building, chopping it up into 10,000 square foot tenants and building out 30% office for each of those spaces. Um, the cost to do that is drastically higher. And so for this light industrial flex space, which is defined, flex is really defined as a space that has warehouse in the back and office in the front. Maybe it's a retail frontage. And typically it's anywhere from 20 to 40% built out and 60 to 80% warehouse. And it can have spaces as small as 2,000 square feet. It's just not cost effective to buy land in these primary and secondary markets. Take Austin or Nashville. Just think about the land cost there and then develop a property that has that level of finish. So the supply is not increasing and the demand for it is continuing to increase. And that's why you've seen rental rates grow as high as, I think in Austin, it's been 10% growth the last 2 years. That's not sustainable, and we're not banking on that being sustainable. 2 to 3% growth, it would be okay with us. Uh, but it's a story as to why all of these quality properties have rents that are way below market. So Austin rents have grown 20% the last 2 years. If you're a perfect landlord and have had 100% occupied property with 3 to 5 year leases, just by default, your leases are roughly 20% under market in 2 years. So there's a lot of opportunity there. Those are really the two reasons that are the two asset classes and the reasons behind them. There's always more nuance to it, but broadly speaking, that's why we like these two asset classes.
Yeah, absolutely. So we've talked about kind of the overall state of the real estate market, talked about our investment thesis and the type of deal that we like. Let's dive back into that deal process. And as you alluded to, you can find an opportunity in multiple different ways through personal relationships, email blasts, online. What is it exactly that you're kind of looking for as you go through that process? Because I know we've ran the numbers in house before, right? And you were looking at, I forget what it was, something like 700 to 900 opportunities a year if you
Yeah.
consider all the email blasts and everything that we look at. How do we whittle that down to somewhere in the, call it 3 to 9 acquisitions a year?
Yeah, that's a good question. A lot of different ways. First off, we've stayed away from doing single tenant acquisition. So if you see ST in a single tenant net lease, typically are going to stay away from that. And we also have a geographical screen as well. So predominantly focused on the Southeast plus Texas, and I would say 2 to 3 select Midwest cities that we really like. And so, those two screens will still leave you a pretty large population. And let's just, the process is the same for medical and light industrial, but let's just use light industrial for an example. We want to first, we're going to look at the type of construction. Is it all metal? If so, what kind of market is it in? If it's in anything remotely coastal, that's pretty much going to eliminate it for us. What's the vintage of the property? Is it older than 1990s? If so, that's probably going to quickly eliminate it from us. Sorry, I'm getting a telephone call. And then, if it looks like an asset, so we kind of apply our general screens, and if it passes those, that's when we actually really dig into a property and look at the rent roll and the location. So location wise, we want it to be in a strong submarket. We want it to be in an area that's convenient and has access and makes sense to own a property in. Obviously, location is a huge component of real estate, and so we do a lot of homework on that. Second, and probably the most important thing from a return standpoint is looking at the rent roll. So if there are 5 tenants, we'd like to see them not all expire at the exact same time. If it's a story where we want to raise rental rates, we'd like, if it's 5 tenants, we'd like to see those tenants not under lease for 5+ years. So if you want to buy a building that has upside in market rental rates, you prefer the majority of the tenancy to be expiring in the next 2 to 3 years. So we like to look for a WALT less than 3 years. Another thing we focus on is avoiding buildings, not always, but most of the time, avoiding buildings that have a tenant that's 40, 50, 60% of the rent roll. Because when it comes time for them to renew, they have a lot of leverage occupying that much of your building, and it's going to be difficult to really drive their rate. And so we refer to that as tenant concentration. So we want to have minimized tenant concentration. It's hard to get that. It's hard to consistently find deals where that's less than 10%, but if you can find a property where the largest tenant is less than 20, and they're kind of standalone in terms of their expiration date, so they don't expire at the exact same time as another tenant, that's an okay situation for us. So we like to, so the rent roll is where I spend a lot of my time after we've kind of ruled out the location and the quality of the asset. Now, circling back, on the asset quality. We generally want a light CapEx load when we take over. So typically we're looking for single story buildings. We don't want elevators. And that changes a little bit on the medical office side, but we like to focus on single tenant buildings that are generally in good shape. Ideally, a roof is under warranty still, so we don't have to worry about that, out of the gate. And we want to see the parking lot also in good shape. Let's see. I've touched on the rent roll. I've touched on the capex and building quality. Obviously, we want to see some level of occupancy. Typically, on the industrial side, we prefer that it's generally full, so 85% plus. We want it to be stabilized when we're negotiating with tenants to drive rates, because that gives you a lot more leverage. Hey, there's no other availability in the building. The submarket's incredibly tight. Typically, for light industrial in the markets we're looking at, it's sub 5%. So it's kind of a take it or leave it stance from us. We're going to be reasonable and go at a market rate, but if the building is full and it's a tenant that only takes up 5 to 10% of the property, you really have a lot of leverage in that situation. Oh, let's see. What components am I leaving out? We talked about the rent roll. We talked about the building. We talked about the location.
Debt markets and how that relates to it.
Yeah, the debt markets. Obviously, if we're buying a property that's kind of stable, we want to use debt to do that. So in the early stages, when we think when a building has kind of passed our initial underwriting and our initial investment committee thumbs up, we will start talking to our mortgage brokers, just to kind of get their feel for what our underwriting terms should be, and also, how likely it is that we're going to be able to find debt for this property. And we're more conservative in the debt world, so we're typically looking 50 to 60% LTV. We're primarily using Lifeco debt, which has surged in popularity over the last year or two with CMBS shutting down. But it's also just a great experience, a lot less hassle and structure than you have to work with on the CMBS side. And so we kick off that process as we submit an initial LOI. Typically, when you submit an LOI, there's going to be a counter, and then you're going to respond either accepting that counter or maybe making a tweak to one or two things. And then it takes another 2 weeks to really negotiate a PSA and get that signed. And so as soon as we feel like the chances of us moving forward on a deal are in that 40 to 50% range, we're going to reach out to our debt team and start running that process. If we can't finance an opportunity, and and it's called for in our underwriting, then we'll just stop there. And that's why we think it's important to kick that process off early.
Yeah, absolutely. So before we wrap it up, because I'm sure we could talk about this stuff for a couple of days and bore listeners with real estate talk, how important is knowing what your principles are? So let's call it investment thesis, what we're trying to solve, the problem that we're out there trying to solve, and relating that back to the debt markets and investor sentiment.
Yeah, it's important to have a defined thesis, because in an environment like this, it's easy to, when things are a little slower, it's easy to just want to make an investment because last year was slow. We only did 3 acquisitions, and one of those was very early in the year, so it felt like 2. So it's important to stay disciplined and not to do a deal just to do a deal. And that's why having a defined thesis, we think, is very important, because it kind of keeps you in check, and prevents you from starting something that you have no business doing or veering into a different lane that's not what you're accustomed to doing.
All right, man. Well, we talked about all the real estate stuff. That's all the fun stuff. You mentioned in your intro that you're a bourbon enthusiast or connoisseur enthusiast. You're a bourbon enthusiast. What's your favorite?
It's a disappointing answer. I don't have a favorite go-to. I'm in the I would say I'm in the hunt for finding that go-to, $40 to $60 price bottle. Right lately, I've really just been finding cool stuff that I'm not going to really, keep buying over and over again, but trying to get a different taste. There's a brand called Pinhook that I bought a bottle from. They never they don't continue making the same bourbon. So every year or whatever, they have a different mash bill or whatever you want to call it. And so they don't keep making the same thing. So it's fun and it's kind of hard to find. It's not expensive. I want to say it was like a $50 bottle, but it's fun to find them and try them and realize that you're probably never going to have the same type ever again. So that's the most recent bottle that I'm working my way through.
Well, last question. And these are bonus, y'all. So pay extra. We've both been playing pickleball for a while. You and I get on a court, 1v1, 10 games. Who wins?
I feel pretty confident that I'm going to win all 10 of those.
All 10?
Yeah.
You do have the tennis background, so I wouldn't be shocked, but I don't know. I
that's
might
the
squeak one
rationale.
out on you.
And also, we'll probably be gassed by like game 6.
That's why
So
I
you
said
might,
10.
yeah, that's smart. I didn't think about that out of the
Yeah,
gate.
2-3 games. You've got all of them. I think if we extended it to 10, I might be able to get 1 or 2 out of there.
Yeah, I mean, I'll make you run though. I have that ability.
I got that in me.
I know you do.
All right, man. Well, thank you for the time. Like I said, we could probably talk about this for days. If you want to get in touch with William to talk more about Excelsior or myself and our investment thesis or just kind of how we think about things, you can reach out via the website, www.excelsior, that's EEXCELSIORGP.com. Or you can just go through any of the channels that you find this podcast on and get in touch with me, and I can always put you in touch with William. So, William, thanks for joining, man. I always enjoy these conversations and kind of thinking about how our process stays true to its principles but evolves over time. And we'll talk soon.
Yeah, this was fun. I appreciate it.